And of course, now to take the tax topic a little further and bring into the ambit perspective on what the overall environment and fiscal policy actually spells for investment and financial planning, now we'll be hearing from Ronald King of PSG Consult. And I'm going to be handing over, Ronald, the baton to you. What you've got to do is point to the booth on that end and click forward. There is a backup, your presentation there, if the system fails again.
Yes, one of the problems that I had is sharing the stage with Mike Schuessler and Professor Arendse, so I actually asked them to sabotage their presentations. It just makes it much easier for somebody like myself to look good when I come up front, and I knew this was going to happen, so I only built 4 slides. It makes it much easier. Of course, it could have been worse for me as well. My mother-in-law could have been here this morning. So I've been saved a lot of embarrassment. As we've seen, there's been no huge announcements in the budgets that actually affect financial planning. But why is financial planning so important? Well, if we look at what is currently happening, we will find that 45.6% of personal income tax is paid by 5.5% of taxpayers. Both Mike and Professor Arendse referred to that. But just break that a little bit further down, and we will find that 15.5% of total tax revenue is paid by 0.7% of the population. Now, we are expecting that rate to increase going forward. And the problem that we have is that most of the tax planning that we could have done has been thrown out of the window. There's very little that we can do with regards to tax planning, which means that the role of the financial planner to increase the financial position of our clients become much more important. If you cannot manage the expense of tax, you need to increase the growth that you're getting on our portfolios. Now, I haven't got time, unfortunately, to talk about it, but I think one of the problems that we have in South Africa is our reckless conservativeness when it comes to investing. We cannot work with tax rates such as we have and have 40 to 60% of our money in cash. Because not only are we losing against inflation, we are also now going to be hit very hard on those things. Professor Arendse already mentioned the changes to the taxation of lump sums from retirement funds. Yes, it's been increased to 500,000, but just bear in mind that the 18% bracket has been reduced considerably, or it's only up to 700,000 Rand. There has been some minor changes as well in the schedules to the budget, and one of those, for example, changes some section like section 11W, where there's a bit of an error with regards to the cession of policies. A very important time this year is actually the implementation date of previously announced changes. So there's a number of changes that was in the previous budget. As mentioned previously already, income protection policies will no longer be tax deductible. Just as PPS finally got it right to get a directive to say that their product is tax deductible, no one is tax deductible anymore. Medical tax credits have been increased, and of course now everything is now being converted to tax credits. So the structure where we had people below the age of 65 on tax credits, but those above 65 still having a medical tax deduction, that from the 1st of March this year is no longer the case. Everything is now converted to a tax credit, which basically means that if you're under the age of 65 and you're paying more than 25% in tax, you will be paying more tax. And if you're older than 65 and you pay more than 33.33% tax, you will also now have a smaller tax deduction than you had in the past. One of the things that they said that they will bring in this year is the tax-preferred savings account. They already have this in other countries. They call it a SIP, a savings investment plan in the United Kingdom. 30,000 Rand, as we saw, per annum, with a lifetime maximum of 500,000 Rand. We will have to see exactly how we're going to put this into financial plans in the future, because one thing that you need to remember is what you take out of this fund, you cannot put back in. So it's going to be very difficult to use it as your emergency fund, for example. it will more than likely have to be something that you look at towards retirement as well. So just an additional way to save maybe for your children's studies. My son is a first-year medical student at Tikkies this year. I've worked out that it's going to cost me about R1 million to get him through university, and that is if he doesn't study like his dad did and do every year twice. I hope he's not listening. So we will have to see exactly what the implications for financial planning is, but I believe that this will be more for your long-term savings plans, for, as I said, that house that you want to buy when you retire, or for your children's studies. When it comes to retirement planning, that's probably where the most changes have been happening over the past few years. I think that we're probably towards the end of all of these changes. This is the last year for the old retirement annuity deduction, where it is 15%, but with no cap. Now, this is very important, especially if you've got a number of high net worth individuals. It might be a good idea for those companies to change their options at their companies, because if they have all the tax implications of their options vest this year, they will still have the 15% retirement annuity tax deduction that they can claim against that. In the future, from 1st of March 2015, the deduction does increase to 27.5%, but it will now be capped at a maximum of 350,000 Rand. So for those people out there who is in the seriously high tax brackets, it might be good to just look at using this last year to benefit from the no cap on retirement annuity contributions. As we've seen, 500,000 Rand tax-free now upon retirement, and 25,000 Rand available tax-free upon resignation. Now, this tax-free amount, the 500,000 Rand upon retirement, can be increased by previous contributions that were not deducted for tax purposes. And here we have a little concern, because in the new section, there is an error in the wording in that it only refers to deductions for pension funds previously not deducted. It doesn't refer to provident funds, and it doesn't refer to retirement annuities. So that means, as the legislation currently stands, from the 1st of March 2015, all your contributions towards a retirement annuity that was not used to increase your lump sum will fall away. Now, we hope that they will change this. It has been pointed out to them, and we believe it would be. Unfortunately, I hoped to see something about that in the annexure. Unfortunately, nothing about it. But I do believe it would be changed. Now, if they do change it, it means that retirement annuities is still an awesome way to plan in an estate. All that you need to know is find out from your client exactly when he passes away. And the day before he passes away, you write him a huge single premium retirement annuity. It doesn't form part of his estate, so you save 20% estate duties. The next day after he's passed away, his family, either crying or being very happy, can then decide to commute the full lump sum of that retirement annuity. And if this error is rectified, it will mean that the full lump sum will be tax-free. So a very nice way of saving 20% estate duties in an estate. You do find a lot of high net worth individuals that sits with 10 million or 15 million Rand in their estate, which is currently not used by them, which they want to donate or bequeath to their children. This way they can put their children on as the nominated beneficiaries of that retirement annuity and transfer it to their children without paying estate duties. Now, having said all of this, it means that we have about 2.5 years before they're going to change this loophole as well. There's a lot of people out there that has a serious problem with retirement annuities. And I would like to just quickly point out that retirement annuities have a massive tax benefit, even if we exclude this recommendation that I just made with regards to estate duties. If we look at a post-tax collective investment scheme, you would contribute, let's say, R1,000 a month over the unit trust itself will pay no taxes. There will be no CGT paid by the collective investment scheme. After 15 years, at a 12.5% return, that investment would be worth R524,000, give or take a few rand. Now on that, of course, in your hands, you will be paying capital gains tax. The capital gains tax on that amount will be 45,000 rand, leaving you with a net amount of 478,000 rand. Just like a good lawyer would do, I did have to write some small font just at the bottom. It is actually interesting, I must say, I'm just a lawyer, talking after an economist is difficult because we do not have that ability to lie like they have. If we look at pre-tax savings, of course, immediately we have to increase the contribution by 40%. Now, please, those of you that still need to write your postgraduate diploma in financial planning, that doesn't mean the contribution is 1,400 rand. It is 1,667 rand. One of the biggest mistakes all of you do when you write your CFPs. The fund growth on that, of course, taxed at zero. The CGT is zero. And after 15 years at the same return, that investment would now be 873,000 rand. If we now deduct the tax on that, 217,000 rand. And this is one of the most important things that we as financial planners need to realize. Financial planning is not about paying the least amount of tax. Financial planning is about getting the most money in the pocket of our clients. And the two are not necessarily correlated. In this case, you can see that you pay a substantial amount of tax more at the end of this period, but if we look at the net amount, assuming that we could have drawn everything, the net amount would be 655,000 rand, about 30% more than you will have in your pocket. So retirement annuities, definitely still a very, very good option. And just be aware of the fact that the only thing that can make this very bad is costs. So just make sure that when you look at some of these retirement annuities out there, you look very closely at the cost. Sorry, I'm echoing there. But just make sure that you do not get fooled by bonuses paying out at the end of the term, covering up costs in some of these products. What was not said, already spoken by Professor Arendse about that, the last year's budget referred to changes in the taxation of trusts. This was to limit the use of the flow-through principle, and was also going to be applicable to offshore foundations. Well, they're currently still in negotiations regarding the matter, and at this stage, there's no clear indication whether it would actually happen at all, or if it were to be implemented, how it would look. So this is still something that when we do financial planning for our clients, be aware and make our clients aware of the fact that we are going to charge them in the future again for another financial plan, because whatever we say today might change in next year. The Davis Commission, of course, has also been set up to provide recommendations on a number of matters. One of the issues are estate duty, CGT, and the interaction between them, as well as regarding recommendations on wealth taxes in general. Now, there are some that says these recommendations are expected in June. The implementation date thereof, of course, is unknown, because the fact that it's recommended doesn't mean that it will be implemented. Please just caution your clients when providing this financial plan. From my side, that is all on the financial planning perspective. I hope that you have an awesome year with your clients. Please remember, yet again, as I said, do not be recklessly conservative and do not try and save taxes all the way. Make sure that you give the best returns possible to your clients to satisfy their needs. Thank you very much.